flagging the drops we've seen in the iron ore price, or actually overdone it, so you could see some take-up or some narrowing of that discrepancy there. But look, considering the volatility in these kind of plays, it's still a bit of a risky bet, isn't it?
It is, and I think it really depends on what you're trying to achieve as to which iron ore miners you'd be looking at. If you're sort of buying into the mid-cap miners, they obviously have much higher cost of production, which puts them, makes them significantly more leveraged towards changes in iron ore price. So yes, if you're betting on an upside or a sustained higher iron ore price, then maybe the shorter term upside potential of the mid-cap and the smaller producers are more significant due to that leverage. But in terms of sustainability, you look at the likes of Rio and BHP, who of course Rio makes the majority of their earnings out of iron ore, but BHP also 50% or more of their earnings come from iron ore. Their cash production costs are significantly lower. I mean, they dig this stuff out of the ground for $40 or $45 cash a tonne. And in an environment where iron ore is expected to fall, the price, as mentioned by many brokers and analysts at the moment, I think it's those larger, more cost-effective miners which are going to be more sustainable in the long run. Because if like Goldman Sachs says, iron ore falls to $80 a tonne, when you take into consideration debt funding costs for the likes of Fortescue and the mid-cap miners, things like that, the total cost of production comes pretty close to those kinds of levels, so they don't become all that profitable. So I think on a longer-term sustainability view, you should be looking at the likes of BHP, Rio, even Fortescue. Fortescue's looking to significantly pay down their debt levels, which will improve their total cost position significantly. But I'm a little bit cautious on sort of the likes of Atlas Iron and some of the mid-cap miners. Yes, they could see a very good bounce if sentiment turns around in the iron ore space, but I think as an investor, and if you do have a bit of a longer term point of view, I think some of the bigger players are probably a better option. And speaking about the disconnect, as mentioned, the Fortescue's price has fallen significantly more than what the iron ore price has. Fortescue, interestingly, also has a very, very strong correlation to the Shanghai Composite, the Chinese equity market, and Fortescue's share price has fallen by about twice as much as the Shanghai Composite has over the past month. So we're seeing a bit of a disconnect there as well. And we have seen some calls in the market that the Shanghai Composite could be looking at a turnaround and some significant upside through this year. So that bodes well for the likes of Fortescue. But I have to agree with what Evan's saying. They are looking cheap and very attractive at the moment.
At the moment, we saw from Virgin's last report card that they are feeling the squeeze, in particular from competition on their routes and some of the price debasement that's happened. Their margins are getting squeezed. But Qantas, the market getting very excited about the Emirates tie-up and the fact that Qantas has been able to stem some of the serious outflow in terms of cash losses from those international routes. But is the airline industry, it takes a brave call, doesn't it, to start throwing the hard-earned there?
Yeah, I think the airline industry is a difficult one. The key, I think, issues with that, certainly high competition, resulting in quite a lot of earnings volatility and still a bit of uncertainty within the longer term. There's certainly a lot of cost pressures within this space as well. But I think in the shorter term, some of the airlines sort of looking attractive. If you look at Qantas, for example, yeah, it's been given the all clear for this Emirates tie-up, and we've already heard from Qantas that this is a significant part of its strategy to turn around the international business. And looking at Qantas at the moment, it trades on something like a 40% discount to its book value. So its book value of shares is something over $2.10 or something around that. It's only trading at $1.70 at the moment. And if you compare it to its regional peers, Air New Zealand, Singapore, Cathay, some of their Asian airlines, it also trades at about a 40% discount to them on a price-to-book multiple ratio as well. And looking at this strategy, I think a lot of analysts are expecting the international segment of their business to start turning around. We did see it record something like a $300 million loss for 2012, but some projections now are for 2015 for the international business to turn a profit of around $100 million. While cash operating cash flows are strengthening at the moment, while we've seen some calls around the market that even though there has been very high competition in the domestic segment at the moment, and that has impacted yields significantly, that's expected to ease a little bit. And looking at this Virgin deal with SkyWest, I think it's important on a couple of levels. Certainly, it's getting a stake within that $1.3 billion per annum regional market, and that regional market does offer better yields than average domestic yields. And also its tie-up with Singapore. This news about Qantas and Emirates, Virgin does need a strategic partner within the Asian region. Virgin to be able to battle this kind of competition. And I think this tie-up both with SkyWest and also the deal with Tiger, if that's to go through, is going to strengthen its allegiance with Singapore. So I think that's going to be a positive. Certainly at the moment, I think longer-term airlines are a very difficult one to call just because of that earnings uncertainty. But in the short term, Qantas in particular, looking pretty cheap at the moment, even after, as mentioned, a pretty strong run in the shares recently.
Space, Tim?
Yeah, well, I mean, I tend to agree. I think I've been looking for a bit of a rally in energy stocks for a while. It hasn't really come. A couple of the big players, Woodside and Santos, they broke through resistance levels on the charts recently, but then we saw a bit of a correction in the oil price and gas prices. You know, oil corrected about 9% from its 2013 highs. It's just held back those prices at the moment. But I think they're still at pretty attractive levels on the market. If you look at their PE multiples at the moment, Woodside trading a touch below 15 times on 2013 earnings. Santos actually trades at a premium to that, closer to around 19 times. But I think that premium is probably warranted for Santos. Woodside at the moment's probably got the more attractive yield and probably more attractive in terms of future increases in dividends. But Santos looks a bit better in terms of future growth prospects. Woodside Petroleum got a number of growth opportunities in the works at the moment and in the plans, except what we have seen in a lot of these big LNG projects, a significant cost blowout. So I think what the market
is that, Tim, is that why we're seeing Woodside continue to languish? I mean, the amount of people who have high price targets on this stock must just be embarrassed, because this thing has been around these 36, sort of mid-30 range for quite some time.
It's extremely frustrating, actually, Woodside's performance. You're right, it hasn't gone all that far, and I think that is certainly a factor. It's got that Browse LNG project at the moment. It's got several other projects, and I was saying cost blowouts have been significant. I don't think there's been any major LNG project around the world that hasn't seen a significant cost blowout. And that makes the valuations of these projects that are factored into share prices significantly less attractive when we see the likes of Chevron announcing $40, $50 billion cost blowouts and things like this. And I think that has weighed on Woodside Petroleum's share price. But Woodside in the past obviously has traded at price levels a lot higher than where it is now. It used to trade double what it does now, but that was in an environment probably where the world was looking at sort of scarce oil reserves. But since then we've seen the US shale revolution, multiple gas finds, significant gas finds, and it looks like now that the prospects for gas prices and oil prices as well as supply side is looking a lot better for the world. So Woodside has struggled a little bit, but as I mentioned, I think a lot of price targets were above $40 or well above $40 for Woodside. I think a lot of analysts, some analysts have been paring these price targets back a little bit. And yes, I think a lot of it is to do with the possibility of cost blowouts in terms of future growth. Because at the moment, they've certainly got that Pluto project, which is performing very well. But into the future, they're going to have to start putting some more money into further growth prospects to really drive earnings moving forward.